Today, we're going to be speaking with J.L. Collins, who's been called by some the godfather of financial independence. He's the author of 3 books, including The Simple Path to Wealth, which is on my list of personal finance recommendations, by the way, which you can find at davidpakman.com/finance. JL, it's really great to have you on. I appreciate it.
David, it's an honor to be here. Thanks so much for the invitation.
So listen, one of the things I've talked to my audience about is I believe one of the greatest tricks that has been perpetrated by the entire financial services industry is making people think that this is a far more complicated topic than it actually is, so that they go and maybe pay too much for a financial advisor. Now, that's oversimplified. There's all sorts of different advisors and advice, different situations. Without question, there's a lot more detail to it. But is it generally the case that much of what is sold to people is sold with the understanding that a lot of this stuff is just too difficult for you to handle on your own?
Absolutely. I think you're spot on. In fact, the reason that this stuff is made so complicated is precisely to drive people into the arms of those who are selling it, because that's where the real money in the financial industry is made, is through commissions and high fees going on. I liken it to, imagine if you had a banquet table filled with every kind of exotic delicacy you could imagine, some of them extraordinarily complex to make, right? You could put your arm on that table and sweep all of that except a tiny corner onto the floor. And that tiny corner would represent the simple foods that are actually healthy and good for you. In the financial world, that's low-cost, broad-based index funds, which is what I talk about. Everything else, nobody really needs. It benefits mostly the people who sell it.
What about those who say, listen, we've all heard about, invest in index funds and chill and all of these other things, but that doesn't account for growing unrealized gains, which will have a taxable implication at the time that you start needing that money. Or, you'll always get the ifs, ands, and buts where people say, yeah, sure, okay, what JL says and what some others say is fine, but it doesn't account for this particular tax consideration or inflation, or what do you say to those counter arguments, to the extent that they are counter arguments?
So first of all, you're kind of talking about two different subjects then, right? And the inflation thing you mentioned at the end, I throw into investing, and that's well covered in with your broad-based low-cost index funds. But yes, the government has made investing enormously complex under the guise of helping us, and I suppose to a certain extent it does, but with IRAs and 401ks and these kinds of tax-advantaged programs that are out there, which people should take advantage of. But that does make the decision making more complex. The investments you put in those plans, again, should be broad-based low-cost index funds. But how you execute those plans, when it's best to withdraw from them, those kinds of strategies around dealing with capital gains, for instance, in your taxable account, or capital gains distributions and dividends, and those, the taxable implications of those. Yeah, those are all tax-related kinds of issues. And for those things, a tax advisor is probably a very useful person to have on your team.
What do you think is the area when it comes to personal finance that's most impactful to the bottom line of one's personal financial situation, but most frequently overlooked? And it can really be anything. Certainly the fees one is paying for the instruments they're using could be a possibility. The impact of interest payments on debt that people maybe are not conceptualizing correctly, or asset allocation that hasn't been appropriately thought through, monthly budget. I mean, really, of all the different things that one can consider, what do you believe is impactful and does not get the attention it probably deserves?
So all the things you mentioned are important and impactful, but the single biggest one I would point out is people need to stop tinkering with their investments. One of the beauties of the simple path to wealth that I lay out is you don't need to understand finance in any great depth. There are a few key things you need to understand. You need to understand where to invest, which we've already talked about it. Then you set that up on autopilot, So you're investing automatically. You don't have to think about it, and you leave it alone. I got a comment recently from a reader who was saying, "Oh, the Simple Path to Wealth was written in 2016. Is it still valid? Does it still work?" Simple Path to Wealth is a plan that spans decades. When I invest in VTSAX, which is Vanguard's Total Stock Market Index Fund, great example of the kind of fund I'm talking about, my holding period is forever. Literally, the only time I'm ever going to sell it is to withdraw a little bit of money to live on when the time comes to live on the time comes to live on the portfolio.
There are
So
folks. I'm sorry. No, yeah, go ahead.
no, I was just going to say, so the single biggest thing is don't tinker.
And
Set it
this
up
has to
and run.
do, certainly, it sounds like, with asset allocation, which every time there is a big market downturn, for example, people often start to wonder, is this actually the right asset allocation for me? I mean, one great example was in March at the start of COVID, where it was unclear whether that precipitous decline was going to persist for a long time. It turns out it didn't, but nobody knew that at the time. A lot of people started writing to me saying, yeah, okay, fine, David, just keep buying and holding, but what now? What now? And my view is, if you aren't able to handle the downturn, maybe you were overexposed to the stock market to begin with, and it wasn't the appropriate asset allocation from the get-go. Maybe you should have had more money in bonds or cash to begin with, rather than reacting to market events. Is that a concern, that people's asset allocation applies only when things are steady, but then all of a sudden when there is some kind of calamity, you say, maybe this wasn't the right allocation for me all along?
Yeah, I absolutely agree with you. And I say to people that if you are going to panic and sell when the market drops, you don't want to follow my advice. My advice will leave you bleeding at the side of the road. It is essential that you stay the course if you're going to walk the simple path to wealth. Because what people need to understand is that market corrections, bear markets, even market crashes are all normal. They're a natural part of the process. Dangerous, scary, but they never last forever. They always pass. And if you panic and run out in them, that's when you're going to get in trouble. So, absolutely, the time to decide whether you are comfortable with your asset allocation is times like now when things are good. And then think through, how will you feel about this if you wake up tomorrow and the market's down 20% or 30 or 40%? And you need to think that through before it happens, because when it happens, the rest of the world's going to be in a panic mode. Everybody's going to be screaming, sell, sell, sell. It's the worst thing you can do. So resolve in your mind how you're going to handle it. And if you're following my path, the resolution you're going to make is you are going to do nothing. As Jack Bogle once famously said in a market crash, don't just do something, stand there.
What about when it comes to alternative assets that might include, 15 years ago, it was all about precious metals and so many companies selling gold online, gold and silver. In the last 5 years, it's been Bitcoin or other sorts of cryptocurrencies. People who say, well, maybe actual direct real estate investments, or maybe more indirectly through a real estate investment trust, et cetera. What role should those asset types have in a simple approach, the likes of which you write about?
So you kind of put your finger on it in a sense when you first started, and you said 15 years ago. And the implication of a comment like that is these things tend to be fads,
Mm.
right? You don't hear about gold and silver so much anymore. Who knows in 10, 15 years if we'll be hearing about Bitcoin or not. I am not a fan. In my world, those things are speculations. When you buy gold or silver, or you buy Bitcoin for that matter, you are hoping that at some point in the future, someone will pay more for it than you did. Now, you might be right, in which case you'll make money, but that's the very definition of speculating. I'm not a speculator. I'm an investor. And the reason that I like stocks and I like to hold them in index funds is when I hold VTSAX, I own a piece of every publicly traded company in the United States of America. And every one of those companies is working hard to make me richer. That's the kind of economic activity I want behind my investments. I'm not a speculator, and I
Now,
hold.
couldn't one argue, to play devil's advocate, that you're speculating, but you're just speculating more broadly on the entire economy of the United States or even of the world if they are American companies that do business globally? Isn't it a it's a maybe a less risky speculation?
Well, you're right. I mean, that's exactly the way to look at it. It is a speculation, first on the United States, because that's a US based fund, but by extension, the world, because as you mentioned, the biggest holdings in that fund are international companies. But that is a much broader speculation than a specific asset class like Bitcoin or gold, silver. If my speculation doesn't work out, if the United States swirls down the sewer, or the world in general does, well, then yes, my speculation is not going to pay off. But we will have so much bigger problems at that point. Whereas if my speculation in some other focused asset class doesn't work out, then that's an immediate financial consideration and problem in an overall good environment. So, yeah, if you are someone who believes that Armageddon is coming, you also don't want to follow my simple path. You probably want to be stocking up on guns and ammo.
Let's talk a little bit about people who maybe it's not that they don't want to follow your simple approach, but feel as though they can't. And what I mean by that is there is a sort of counter movement to the financial independence movement that you and others write about, which is this is all great if you have a certain type of job and a certain level of income. But for a country where 40% of Americans can't even afford an unexpected $400 expense without having to charge it or borrow from somebody they know, and all of the other things we could talk about, stagnant wages and all of these different things, even getting started in this approach seems completely inconceivable. All right, index funds, I'm in $10,000 worth of credit card debt and I'm struggling to afford food, for example. What about that broader systemic critique of your approach?
What a perfect question for today, because yesterday my new book, Pathfinders, launched. And Pathfinders is a follow up to The Simple Path to Wealth. And in it is a collection of 100 stories from people all over the world, starting from all kinds of different economic situations, who are following the simple path to wealth successfully. And one of the things that I've said is I've read these stories because that pushback that you described is one of my pet peeves, is that you cannot read the Pathfinders and then say, in all honesty, that this can't be done, regardless of where you're starting from. I guarantee that virtually everybody listening to us, if they pick up Pathfinders, they're going to read stories about people who have started from a more challenging position than they're currently facing. So you may read it and say, you know what, I don't want to follow that path, but you'll never credibly be able to look in the mirror and say, I can't do it, because you'll be reading about people who have done it and are doing it, and probably starting from tougher situations than you. Now,
What is step one in those situations? I guess is the question many in the audience might be asking.
well, step one, if you are carrying debt, you cannot become wealthy. You cannot become financially independent carrying debt. And it's stunning to me how in our culture, the idea that we carry debt, that we buy things on credit and pay it off on time is considered normal. To me, it's like being covered with blood-sucking leeches. I mean, obviously that's going to drain your life energy. So the first thing you need to do is pull out your sharpest knife and start scraping the little bloodsuckers off. And of course, you do that by somehow arranging your life, and this is not easy, but other people in more challenging circumstances have done it, so that you free up money to begin paying down that debt. And I say start with the highest interest rate debt, pay that down, because that's the most powerful economic thing you can do. Now, here's the silver lining, because David, once you pay that debt down, you've developed a wonderful habit. You've developed the habit of not spending every dime that comes your way. And now you have all that money that was going into debt repayment that you can now channel into your investments and begin building your wealth. So if you're starting from a position of being in debt, it simply means that you have a little longer race to run than somebody starting at ground zero. Or for that matter, a lot of people listening will probably already have some investments and are further along that path. So everybody starts at a slightly different starting point. The last thing I'll say about this is that, yes, it can seem a long way from wherever you are to being fully financially independent. But that's kind of like going to the gym for the first time, right? You're not going to be bench pressing 300 pounds on the first day. But the first day you go to the gym, you walk away a little bit stronger. And it's the same thing once you start paying down your debt and or investing. The moment you start, you're a little bit stronger than you were the day before. And that builds. So it's not an on-off switch. It's a process. It's a journey. It's a path.
We've been speaking with J.L. Collins. The new book is Pathfinders. One of his previous books, The Simple Path to Wealth, is on our list of personal finance recommendations at davidpakman.com/finance. JL, really appreciate your time and insights today.
Hey, David, I appreciate being on the show and wonderful questions. Thank you.